If you are retired or planning to retire soon, 2026 could quietly put extra money back in your pocket, and many seniors don't even realize it yet. Headlines are throwing around numbers like $450 in savings, but what actually matters is who qualifies, why this change exists, and how it really affects your taxes. Because this is not a blanket giveaway, and it is not what many people think it is. The change comes from a new tax law passed under President Donald Trump, officially called the One Big Beautiful Bill Act. While the political name grabs attention, the real impact hides inside the fine print, especially for Americans aged 65 and older. The law introduces a new senior-focused tax deduction that quietly reduces taxable income for millions of retirees starting in 2026. One of the biggest misunderstandings is the claim that Social Security is now completely tax-free. That is not true. Social Security is still taxable depending on your total income. What changed is how many people will actually reach the taxable threshold. And that difference matters more than it sounds. Under the new rules, anyone age 65 or older can claim an additional $6,000 tax deduction on top of the standard deduction. If both spouses are 65 or older and filing jointly, that extra deduction doubles to $12,000. This deduction directly lowers taxable income, which means fewer retirees cross into the range where Social Security benefits become taxable. This deduction is not permanent, but it is not short-term either. It applies from 2026 through 2028, giving retirees several years of relief during a time when healthcare costs, insurance premiums, and everyday expenses are rising faster than benefits for many households. Eligibility matters. The full deduction is available to single filers earning up to $75,000 and married couples earning up to $150,000. Above those levels, the deduction begins to phase out gradually. It disappears entirely at $175,000 for individuals and $250,000 for married couples. That means this benefit is designed primarily for middle-income retirees, not high earners. So where does the $450 number come from? It's not a promise. It's an example. Analysts looked at a retired married couple, both over 65, earning around $48,000 a year. Before this law, their tax bill would have been higher. After applying the new deduction, their taxes dropped by about $450. That equals roughly a 1% increase in take-home income, without earning an extra dollar. For retirees living on fixed income, that difference is meaningful. It can cover several months of prescriptions, a utility bill buffer, or unexpected medical expenses. And unlike COLA increases, this relief comes during tax season, when many seniors feel the most financial pressure. Another reason this change matters is timing. In 2026, many seniors may face higher healthcare costs while losing access to ACA subsidies that previously helped cover premiums. At the same time, about 75 million Americans rely on Social Security checks as a core income source. Lowering taxable income helps reduce the risk of those benefits being partially taxed. Lawmakers promoting the bill argue that nearly 90% of seniors could end up paying no federal tax on Social Security benefits at all, not because the benefits are tax-free, but because income levels fall below the taxable threshold after deductions are applied. That distinction is critical. Still, not everyone benefits equally. Retirees with higher combined income from pensions, investments, or withdrawals may see limited or no savings. Others may see smaller reductions than the $450 example. The actual benefit depends on filing status, total income, and how close you are to Social Security's taxation thresholds. The biggest mistake retirees can make is assuming this happens automatically. Tax deductions only help if they are properly applied. Filing status, age qualification, and income reporting all matter. This change rewards awareness, not assumptions. What makes this law powerful is not the headline number, it's the quiet shift it creates. By lowering taxable income, it protects more seniors from seeing their Social Security benefits pulled into the tax system at all. That's a structural change, not a one-time check. For retirees, the message is simple but important. 2026 is not about getting richer. It's about losing less. And for many seniors, that difference could mean breathing room instead of stress when tax season arrives. If you are 65 or older, the smartest move now is not excitement. It's preparation. Understanding how this deduction applies to your income could determine whether you keep that $450 or never see it at all.